Hello and welcome back to Financial Freedom Hub. In today's video, we're going to explain what current liabilities are and why they matter for investors. We are going to explain current liabilities, short-term and long-term debt, and current portion of long-term debt from point of view of the richest investors in the world. You might want to check out our playlists, How to Interpret Any Company's Income Statement, and How to Interpret Any Company's Balance Sheet. Subscribe to our channel and enable notifications. You will learn to interpret financial statements the way the wealthiest investors do. You will have the ability to make safe investment decisions, not based on luck. And yes, imagine, you will make those decisions with confidence and peace of mind. So, let's get started. Current liabilities are a company's short-term financial obligations that are due within 1 year or within a normal operating cycle. An operating cycle is the time it takes a company to purchase inventory and convert it to cash from sales. Current liabilities are important because they show how much money a company needs to pay its creditors in the short term. This affects the company's liquidity, which is the ability to meet its financial obligations with the cash or other current assets it has on hand. A company with high current liabilities relative to its current assets may have trouble paying its bills on time, which could lead to financial distress or even bankruptcy. On the other hand, a company with low current liabilities relative to its current assets may have excess cash that it can use for investing, expanding, or paying dividends to shareholders. There are different types of current liabilities that a company may have on its balance sheet. Some of the most common ones are accounts payable. These are amounts that a company owes to its suppliers for goods or services that it has received but not yet paid for. For example, if a company buys raw materials from a vendor on credit, it will record the amount as accounts payable until it pays the vendor. Accrued expenses. These are the expenses that a company has incurred but not yet paid for. For example, if a company pays its employees monthly, it will accrue the wages and salaries that it owes to its employees at the end of each month until it pays them in the next month. Deferred revenue. This is the revenue that a company has received in advance for goods or services that it has not yet delivered or performed. For example, if a company sells annual subscriptions to its customers, it will defer the revenue that it receives upfront until it provides the service throughout the year. Short-term debt. This is the debt that a company has to repay within 1 year. This may include bank loans, commercial paper, or bonds that are maturing soon. Short-term debt is usually used to finance the company's working capital needs, such as inventory or accounts receivable. Current portion of long-term debt. This is the portion of the long-term debt that a company has to repay within 1 year. Long-term debt is usually used to finance the company's fixed assets, such as property, plant, or equipment, and the company has to repay it over the period of longer than 1 year. Long-term debt may include mortgages, leases, or bonds that have a longer maturity. One of the key factors that investors and analysts look when evaluating a company's financial health is the ratio of short-term debt to long-term debt. This ratio shows how much of the company's debt is due in the near future versus the distant future. A high ratio of short-term debt to long-term debt means that the company has to pay a large amount of money in a short period of time, which could put a strain on its cash flow and liquidity. The opposite, low ratio of short-term debt to long-term debt, means that the company has more time to pay off its debt, which could give it more flexibility and stability. Some businesses, especially banks, try to make money by borrowing short-term and lending long-term, because historically, short-term money is less expensive than long-term money. This means that they borrow money at a lower interest rate for a short period of time, and then lend it out at a higher interest rate for a longer period of time, using those same loans as collateral. This way, they hope to earn a profit from the difference between the two interest rates. However, this strategy is very risky, because it depends on the stability of the money market and the credit quality of the borrowers. If the money market changes, and the short-term interest rates rise above the long-term interest rates, the banks will lose money on their loans, and have to pay more on their borrowings. Moreover, if the borrowers default on their loans, or the value of the collateral drops, the banks will have to write off their losses or provide more collateral to their lenders. This could lead to a liquidity crisis or a solvency crisis for the banks, as they may not have enough cash or assets to meet their obligations. A famous example of a bank that failed because of this strategy was Bear Stearns, a global investment bank that collapsed during the 2008 financial crisis. Bear Stearns was heavily involved in the subprime mortgage market, which was based on lending money to people with poor credit histories to buy houses. Bear Stearns borrowed money from the money market at low interest rates and used it to buy mortgage-backed securities, which were bundles of subprime mortgages that paid higher interest rates. However, when the housing market crashed and the subprime borrowers started to default on their mortgages, the value of the mortgage-backed securities plummeted. The lenders who had lent money to Bear Stearns demanded more collateral or repayment, but Bear Stearns did not have enough cash or assets to satisfy them. The bank faced a run on its liquidity and was unable to find any buyers or partners to rescue it. The Federal Reserve Bank of New York provided an emergency loan to try to avert a sudden collapse, but it was too late. The bank was sold to J.P. Morgan Chase for $10 per share, a fraction of its pre-crisis value. Another line you might see in current liabilities category is long-term debt due. Long-term debt is not a yearly current liability for most businesses. Yet, a few large corporations may have some portion of their long-term debt coming due every year. What we have to know is that it can be confusing if the company shows it as a lump sum of short-term debt. This creates an illusion that they have more short-term debt than they really have. As a rule, good companies with durable competitive advantages do not require long-term debt to run their business and have no or little long-term debt ever coming due. On the contrary, if we see a lot of long-term debt coming due, it might not be a company that can make us financially free. But there is a catch. Sometimes you might see a good company with durable competitive advantage that has been going through troubled times due to a one-time event, like a subsidiary or a different business losing money. In that case, we need to look at the time horizon to see how much of the long-term debt is coming due in the coming years. Too much debt coming due in a single year can spook investors and open an opportunity for us to buy a good company at a lower price. Let us give you an example. Suppose we are interested in buying shares of Company A, which is a leader in its industry and has a strong brand name. Company A has a total long-term debt of $10 billion, but it has to pay back $5 billion of it in the next year, and the company has a low current ratio of 0.5. However, if we look deeper into the situation, we may find out that Company A has a temporary problem that caused its earnings to drop significantly in the last year. Maybe it had a legal dispute with a competitor, or a product recall, or a natural disaster. Whatever the reason, Company A expects to recover its profitability in the next few years and generate enough cash flow to pay off its debt. In this case, Company A is still a good company with durable competitive advantage, but it is undervalued by the market because of its low current ratio. This is a great opportunity for us to buy its shares at a bargain price, as long as we are confident that the company can overcome its temporary setback and resume its growth. For conclusion, let's make a short summary of what we just learned. The ratio of short-term debt to long-term debt is one of the key factors when evaluating a company's stability. Borrowing short-term and lending long-term can make you a lot of money short-term, but can easily lead to financial disaster and bankruptcy. For financial freedom, we should look for stability and avoid companies with a high ratio of short-term to long-term debt. We should keep in mind that a good company does not need long-term debt to run its business. Long-term debt due is not a regular current liability. You should always be aware of the context and look at the time horizon. For mediocre business, it might mean financial troubles and even bankruptcy. For good businesses, with durable competitive advantage, it might mean buying opportunity, because it creates low current ratio, which analysts and investment advisors are afraid of. Current ratio over 1 is considered good, and below 1 is considered bad. This holds true for regular companies, but good companies, with competitive advantages that can make you financially free, have strong earnings and cash flow to cover all their current liabilities. They don't need the liquidity cushion. We hope you enjoyed this video and learned something new. If you did, please give it a thumbs up and subscribe to our channel for more videos like this. And if you have any questions or comments, please leave them below. We love hearing from you. Thank you for watching and see you in the next video.